college financial aid strategy and applications, some of the pitfalls we should avoid, and depending on different income level, whether it's low or medium or high, you all are entitled to the financial aid if you know how. And sometimes if the financial aid is not ideal, you also can appeal. So we'll cover all these key topics here. It is my honor to introduce our guest speakers today, Lindy and David. I've known Lindy and David for a while, really enjoyed working with them. Their work ethics and professionalism are just bar none. Heads down. So I really enjoyed working with them and appreciate the knowledge. They truly are passionate and care about educating our families about financial aid and really willing to extend their helpful hands to you. So Lindy got her MBA in finance. She also is a VP for Huaxia Women's Association. She's also a VP of America Southwest Chamber of Commerce. So welcome, Lindy. David also lives in LA, SoCal. David has been a financial aid consultant for quite some time, and he brings a wealth of knowledge and just really genuine. Our mission is to be the AI-powered counselor and the GPS system for high school students on their journey to dream college. When I say AI powered, it is really not meant to replace our experienced counselors, but really augment them so that we can meet the challenges of today. We have accumulated 15,000 students' resumes, the journeys that they've shared with us. And out of that big data, we are looking for patterns. And this is a purely bottom-up approach, in contrast to the human private counselors' top-down approach. So we want to be able to show our students, our high schoolers, and the families to show when 15,000 students go from point A to B, what are the mistakes they made? And how do we do course correction so we make sure our current high schoolers take the path of least resistance, the most effective way to get from point A, which is high school, to point B, which is their dream college. Along with that big data approach, it's a very scientific proof. It's very transparent. When you enter your data, where you're from, your ethnicity, your location of the high school, your GPA, your SAT scores, etc., your extracurricular, the outcome is predictable. So we can do that scientific experiments over and over and get the same results. And that is the GPS system we wanted to break up. The big data and machine learning is really looking across 15,000 students' individual college journey and derive the insights, derive the patterns so that we can provide a GPS system for our high schoolers and augmenting our private counselors' experience. Now, we do work very extensively with highly qualified educators, whether they are teachers, tutors in high school, or whether they are former admissions officers, or they are private counselors or counselors from private schools. We work with all of them because we recognize the importance of that human touch. And not just educators, our parents too. So parents, sometimes you have to nudge, sometimes you just have to sit and chill. But together with the educators, study buddies, and parents, and mentors from our summer programs, we are forming a support circle. I will ask Lindy to take over to start sharing your slide deck. So Lindy, over to you.
Thank you so much, Rebecca. That was great information. And I will start with our session. David?
Well, I just want to thank everyone for joining us on this very special segment and workshop is offered to our families. Thank you, Rebecca, for providing such valuable knowledge and information through this AI system that is completely revolutionizing the entire college industry. Today, Lindy and I have a great pleasure to speak to you about financial aid strategies. Both Lindy and I are financial consultants, and on a weekly basis, we conduct many workshops online for families all across the United States. Recently, we are having a lot of great results and feedback from families because our strategies and step-by-step methods are indeed working. What are we talking about today? We are going to delve into how much does it cost to attend college, how to apply for financial aid, and how to receive these types of money from the school. What are some of the changes that are going to take effect in the years to come? And how you, the family members, have the ability to calculate your financial portion that is owed to the school. And also, you want to stick around because we want to give you some tips and strategies for those of you that are considered low income, middle income, and also high income families. So let's begin. The first segment of the program will start with the question, how much does it cost, Lindy, for an average middle income family to attend a public or private university?
Right. Thank you, David. And, basically, this is often asked question by parents. A lot of people think, oh, the cost, what exactly is the cost of attendance? Cost of attendance is actually not just the tuition and the fee. It also includes room and board, books, supplies, and the loan fees, and also sometimes include the, health insurance costs and the local transportation. That you can always find this information on the school website. But is this exactly how much your family is going to pay? The answer is no. It really depends on how your family plan for that. So EFC is the expected family contribution. That's something that, is based on family's income and assets. And to use the cost of attendance minus the family expected family contribution, that would be the financial aid needs. David, do you know that what included in the financial aid?
There are two types of financial aid. There are what's so-called the need-based and the merit-based. It's the need-based that most likely is contributed to how much is based on the cost of attendance subtracted from the expected family contribution. Is that correct, Lindy?
Yes. So basically, for need-based financial aid, a lot of parents ask me this question, do we need to pay back? Actually, they are different type of financial aid. There is a grant. Of course, a grant is a free money. You never need to pay back. And also, the school will offer campus work opportunity, but there's no guarantee. It's normally first come, first serve. And the school will give the students some chance to work in the campus and they get paid so they can use the money to pay for their tuition. That, of course, it doesn't need to pay back. And the last category will be the student loan. They are all different type of loans. There is actually sub loan and unsub loan, and the loan interest rate are also different. They are somewhere as low as 2.7%, or some loan are even 5 to 6%. So basically, if you control your EFC well, you reduce your family contribution. Therefore, you will more financial aid needs. That means that you will get more financial aid, the support from, from federal, from state, and also from school.
Wonderful. So now we know how we calculate the EFC, which is the key element when it comes to financial aid. Now let's focus on some of the changes that are going to take place, especially in the year of 2023. So can you explain more, Lindy, what are these changes?
First of all, I want to cover why this change happened. It's all because, actually EFC can be very confusing for parents. When you talk about the expected family contribution, a lot of family think, okay, that's how much I need to pay. Actually, that's just your expected contribution. It doesn't mean you will get a full amount of financial aid. Even your family financial aid needs, let's say it's 40,000, but the school and the federal may not 100% meet your needs. Maybe even your needs is 40,000, they only offer you 27,000. So the rest, the parents still have to find a way to pay. Because of that confusion, so now they change from EFC to SAI. What is SAI? SAI is a student aid index. That calculation would be pretty similar with EFC, but the good thing is that SAI can be negative, which means the aid that the student receive would be even higher than cost of attendance. There is a possibility for that. And all the changes we see that a lot of changes are actually favor the family and the student. For example, they allow students have some, non-countable assets. And for income allowance, the IPA is income protection allowance. That means the student and parents can make more income that's not calculated as family contribution. And also for the child support for divorced family, before child support is calculated as income. Now it's only calculated as asset, which means the percentage will be a lot lower. And also another biggest change, we say that the 529 that opened by grandparents, before it was treated as untaxable income. Now you don't need to report anymore. So that's all favor to the family. But what's really not favor to the family is if you have multiple students in school, before there was like a more, excluded, there actually a discount for the second or third child. But with these changes, this apparently this advantage is probably will go away. We will know more about it next year because this will happen in 2023. So the changes, the filing date will be October 2022. So before that, we'll know more. And what not favor to parents, also the parents' asset allowance actually is reduced. With those changes, and also, the questions is reduced. It seems like a good change, but the thing is that the parents need to be more knowledgeable because, with the changes, the majority of the question will be transferred from the tax return form. But we saw so many mistakes happen during these changes. So the parents need to be more knowledgeable to know the estimation, and they need to put more of their assets from countable to non-countable. So those are the changes we say that is coming.
Great.
And I know with those changes, and we need to avoid a lot of mistakes. David, you have been so experienced to help many families review their FAFSA and CSS. So can you just give us a little bit, talk about the common mistakes that you have seen based on your experience?
Absolutely. I do have the experience working with a lot of great families during this past few months. There are some common mistakes and misconceptions can be derived from filling out FAFSA and CSS applications. Some of those families have the impression that there are some Ivy League schools that once you apply for financial aid may reduce your chances of being admitted to these colleges. That is false. There are many colleges such as Brown, Dartmouth, even Yale and Stanford that offer families a lot of financial aid packages that are considered what's so-called need blind and has absolutely no impact on your admission process. There are a lot of times that we hear and we receive a lot of emails from families that I cannot be qualified to receive for financial aid. And we ask, may I ask, what's the reason for that? And the clients and the families state that because I'm making over $200,000, I have a large number of assets under my possession. But we always reiterate to families that financial aid is always available for all families with all different level of income. If you plan early and if you know how to take the right steps and strategize and know how to manage your income and assets, you too, the person who is making over 200,000 plus, is able to receive some, if not a substantial amount of grants. We do have some results that Lindy and I will go to share with you later on this segment. Another misconception is that a lot of families have the impression that the primary residence is considered as a form of investment on the FAFSA applications. I have some great news to tell you. FAFSA excludes your primary residence as an investment, so please do not report your primary residence as an investment in the FAFSA applications. And also there is a methodology which is offered from the federal and institutional learning centers. FAFSA is normally offered and designed by the federal government to give students different form of aids, which we initially talked about it in our previous slides. And CSS is a form of application that is offered by over 400 plus public and private universities. And it's additional money to the FAFSA that you are going to receive from the government. And please, folks, I have some news for you. Do not take advice from the people and the individuals do not have the qualification or expertise in the area of college, because there is a lot of tricks and in and outs that we know because we are working directly with colleges and we always have direct access to these resources. Okay, now we move on to what's so-called the EFC calculation. So what is really EFC calculation and why families should be mindful at these type of applications and formulas, Mindy?
Yes, so basically you can say from this formula that ESC actually include the parents' income and parents' assets and students' income and students' assets. So due to the time, we wouldn't have time to go through all the detail. We actually have our weekly workshop to teach people exactly how to calculate and how to make the changes, how to come up with the strategy. So overall, parents need to understand that, some students have, like my daughter, I'm a business owner, I pay my daughter, and, but I have to pay them to certain amounts, so they don't trigger them to, 50% of their income will become like a family EFC. So I make sure that I pay them less than about $7,000. And if you have assets, of course, we recommend you to move your assets from countable to non-countable. But if you really cannot do that, you rather put under parent's name instead of student's name. As you can see, if it's under student's name, and the percentage will be a lot higher than it is under parent's name. So, overall, we just want you to be mindful where you actually put your assets and how you calculate your income. So for majority of the families really don't have the issue with the students' assets, the student income. Most of the students don't have much income and they don't have accessible assets. But when it comes to parents' income, it's generate a big percentage. We have a concept called AAI, Adjusted Available Income. AAI actually is calculated from AGI, that is Adjusted Gross Income, and we use the AGI to add back the deferred contribution and manage the tax, living expenses, employment allowance, and also for some like a private school, if you use the CSS institutional methodology, and the health expenses will be reduced. Because of the time, we don't have time to go through all of that, but all I can tell parents is you can say from the right to schedule A, B, C, D, E, that's on your tax return form. So what we always help parents to use is like all the CDE can help you to reduce the AGI. The lower your AGI become, if the lower your AAI will become, that actually means that you have more, your EFC will be lower. But in terms of how to reduce AGI, this from the chart on the right, you can see CDE, these 3 schedules can help you to reduce AGI. We do have separate tax saving strategy workshop to teach people how to use the Schedule C to write off the expenses. And the parents, some parents, if you qualify, you can even pay your kids from paying your kids and reduce your taxable income in order to reduce your EFC. We just help parents in Maryland, and they even for last year, we were able to help them to pay their kids for over $30,000. So then they actually reduce the parents' AGI. Yesterday, I was just meeting with a client from New York, and she's actually making pretty good income, over 400,000. And her kids go to college. She didn't get any financial aid. But after we review the situation, we help them to just tell them they can actually put their income in the state corporation and then pay themselves the W-2. With that changes, they can totally get a lot of financial aid. So we always say the parents, you don't know what you don't know, but sometimes you pay big price of the things you don't know. We need to pay attention on that. And another one is David. We always work with parents. You can see that in terms of assets, there is also countable and non-countable. That means, for the left-hand side, the brokerage accounts, the cash, saving, checking, the 529 education ARA, the real estate, the rental property, and also the business. If you have your asset under this side, so every penny you make, you have to take a percentage to put into the college cost. But if your asset is in the right side, whether it's in your retirement account, in your insurance, in your annuity or HSA, those will become non-countable. So basically, for the money you have on this side, you do not need to pay for the college. That actually will,
Basically, for the families, they have to keep in mind, there are 2 different assets. One is so-called the countable asset, in which you can see a list of items on the countable assets. And the countable assets will definitely have an impact on your expected family contribution. So what we do as financial consultants and college planning experts, we offering you what's so-called the non-countable assets. So when the time comes for you to fill out your financial aid applications, we will help you to properly structure your asset so that you do not have to pay extra money out of pocket when you about to receive your financial aid package. So having said that, Lindy, how do you, in a practical sense, can help a family reduce their AGI? Because I'm sure there is a lot of question right now with a lot of our families, and just these numbers and these names may sort of just make them very confused. So do you have any case studies or practical knowledge that you can offer to families?
Well, I'm glad you asked. This is actually a real case that is for 50 years old couple. They have a kid, and their AGI is not very high, but they have a home equity of $220,000, and they have a rental property worth $1 million, and they have asset in the countable assets. So their kids got accepted by Pomona, and they didn't receive any financial aid. But when they came to me, I evaluated their situation. What we did, we actually helped them to move back to their more expensive property, use that as their primary house, and for the lower value property, use that as a rental, and to remove those countable assets to non-countable. So they end up, you look at the chart on the right, they actually received the $42,000 grant, 35 being the grant from Pomona and also Pell Grant. So with that changes, actually this family, the second year, they came back to me again because they sold the property with a lot of income. Their AGI become over $3,000. But still, we helped them to appeal. The second year, they were able to receive $33,000. So there is always a way for family to manage, to sort out like a strategize.
You know what, Mindy, what it stands out to me the most? I see the AGI is $45,000. So obviously our first impression is because they have low income, then automatically they qualify for a lot of financial aid. But it happens the opposite because they have lots of assets under their names. But as you can see, even with the EFC, as we have offered them the strategies, there is a big difference and significant change from $55,000, which is your portion, the family, but instead you end up only paying what's so-called $30,000. So that's a huge difference, isn't it?
Right. From what you can see with this example, sometimes if your asset hit some ceiling, even family EFC is 55, but school, because they have a big asset, school didn't offer them anything. But with our, advice and changes, they were able to receive 42,000. So that's a 42,000 versus 0. So that's a big change. Wonderful. You may ask that, it's not, I'm telling you, David, it's not only the lower income family can get financial aid. I'm going to show you, because the family with their different type of family, low income, low asset family, there's really not much you need to plan. All you need to do just understand the EFC and SAI and make sure you fill out the form correctly. Do not make any mistakes. Then you will get good financial aid. Look at this family we helped. Those are all this year example. And they're low income, low family, and we apply, fill out the form correctly. They were able to get $28,000 and also student loan and work study. Family doesn't need to pay anything. And another category will be, low income but high assets. Let's just do something about the assets in terms of how to do that. In our future workshop, we can cover more, but just to show you example, this family, they have a high asset. We were able to help them to move assets from countable to non-countable. They were able to get $62,000, $53,000 being grant, free money. So how much, 1 year, 53, 4 years will be $200,000, right? That's after tax. And then this is a category that need the most work, and they're middle income. They have some assets. Of course, we will have the way to reduce some sort of the income. And there are different ways, just like I shared with you for the parents in New York, we help them to pay them less. And some family, remember David, in that family in Sacramento, he was able, after he talked to us, he was able to defer the income. So this is an example. Middle income family, we help them to do some adjustment. They were able to receive $45,000 grant from Caltech. Those are all examples of this year. The last category will be high income, high asset family. So for those families, to be very honest, for them to qualify need-based financial aid, that chance is very small, but doesn't mean they don't receive anything. If they strategize well enough, they can still have a chance to receive a good financial, scholarship. And for those group of family, I strongly suggest those families focus on tax saving strategy, because we had experience, we help family to save tax for like $500,000, even $1 million over the year. So this is a perfect example. We help this family. They actually, high income, have assets, and they got, the kids got accepted by Washington University, St. Louis. It's the best pre-med school. They were able to get a $40,000+ grant. So there is a room for every family. You just need to understand, plan ahead of time, and be prepared, be mindful.